Look, while everyone was celebrating the stock market's impressive 16% gain last year, something far more significant was happening in a corner of the market that most investors completely ignored. And I need to show you this because what happened in 2025 wasn't just another bull run in precious metals. It was a complete restructuring of how global capital views safety, inflation protection, and the future of industrial civilization. Ladies and gentlemen, the metal guy here, it's January 20th, 2026. And 3 weeks into the new year, I'm watching something that shouldn't be possible according to everything the financial textbooks teach us. Gold just hit another all-time high. Silver is trading near $90 after more than doubling in 2025. Platinum posted gains that left Wall Street analysts scrambling to rewrite their forecasts. And copper? Copper quietly became the industrial metal that every major corporation on Earth is now scrambling to secure. But here's what the mainstream financial media isn't telling you. While they were focused on artificial intelligence stocks and semiconductor companies, while they were tracking every word from central bank meetings, while they were debating whether the economy was heading for a soft landing or a hard landing, metals weren't just outperforming other assets. They were obliterating them. Silver gained 145% in 2025. Read that number again, 145%. Gold climbed 64%. Even palladium, which analysts had written off as a dying industrial metal, jumped 70%. And when you look at the top-performing exchange-traded funds of last year, the top 15 spots were all claimed by precious metals funds, not artificial intelligence. Now, I've been tracking commodities markets for over a decade. I've seen crashes. I've seen everything the market can throw at you. This was investors piling into the next hot trade. This was institutional capital, sovereign wealth funds. And here's the part that should terrify anyone holding traditional assets. The reasons metals dominated in 2025 aren't going away in 2026. In fact, according to every data point I'm tracking, the forces that drove precious metals higher last year are accelerating, they're intensifying, and they're about to collide with supply constraints that could push prices to levels that would have seemed impossible just 2 years ago. So in this video, I'm going to show you the specific catalysts that drove each metal higher. And most importantly, I'm going to tell you what this means for your money in 2026. Because whether you own metals or not, let me start with the numbers because numbers don't lie, even when headlines do. According to verified market data from multiple major financial sources, that's not a typo. 145% in a single year. But silver wasn't alone. Platinum gained approximately 135%, making it the second best performing precious metal. Gold, the traditional safe haven, the anchor of the precious metals complex, climbed 64% to close the year above $4,300 per ounce, after hitting more than 50 new all-time highs during the year. Even palladium, which faces long-term headwinds from the shift away from gasoline-powered vehicles, managed to gain 70%. Now let's compare that to other asset classes. The benchmark stock market index gained 16.4% in 2025. That's actually a solid year by historical standards. The long-term average annual gain is less than 11%, so 16.4% is nothing to complain about. International equities did slightly better, with certain markets posting gains in the 20% range. But compared to metals, stocks didn't even come close. Even the worst performing precious metal, palladium, more than quadrupled the stock market's returns. And here's where it gets really interesting. Now, when you look at exchange-traded funds, we're all precious metals funds, the number one spot went to a junior silver miners fund, which gained 195%. Only after that stretch did funds tied directly to physical metals appear, with silver ETFs posting gains around 148%. Technology funds? Artificial intelligence ETFs? Now, before we go any further, I need to address the skeptics, because I know what some of you are thinking. This is just a bubble. This is just speculation. Metals rallied because of fear and hype, and now they're going to crash back to earth. This wasn't retail investors on social media pumping silver to the moon. According to verified data, central banks don't speculate. Central banks don't chase bubbles. According to reports, it was primarily emerging market central banks, nations that are actively trying to diversify away from dependence on the dollar system. This isn't speculation. This is strategic positioning by sovereign entities that manage hundreds of billions of dollars in reserves. Silver has been in a structural supply deficit since 2021. According to commodity research, and that deficit isn't shrinking. Gold demand in 2025 surged, and supply? Mine production increased modestly, about 2% year over year to 977 tons. But that's nowhere near enough to satisfy the surge in demand. Third, let's look at the industrial side. Copper gained about 40% in 2025. This is actual consumption from sectors that are expanding rapidly and have nowhere else to turn for the materials they need. And silver? Demand from the electrical and electronics sector has surged 51% since 2016. Why? In electric vehicle charging systems, in AI data center infrastructure, literally, that were undervalued for decades while central banks printed trillions of dollars and governments accumulated record levels of debt. And I see the early stages of a structural shift that is going to reshape the global financial system. Now let me walk you through the specific catalysts that drove metals higher in 2025. Catalyst number 1, the Federal Reserve's policy reversal. After aggressively raising interest rates in 2022 and 2023 to fight inflation, and here's the key, lower real yields, meaning interest rates minus inflation, have historically been rocket fuel for gold and silver. Why? Because when you're earning 1% or 2% in a savings account, but inflation is running at 3% or 4%, but it wasn't just the rate cuts themselves, it was the messaging around them. A fundamental regime change. According to market analysis, that speech indicated the central bank was prioritizing employment over inflation control. Translation, they were willing to let inflation run hotter to avoid a recession. And the market heard that message loud and clear. Catalyst number 2, dollar weakness and reserve currency doubts. According to multiple verified sources, this was about confidence. Confidence in American diplomatic relationships, confidence in the stability of the reserve currency system, the administration's aggressive tariff policies, its territorial ambitions, its public conflicts with traditional allies. All of this created uncertainty about the future of the dollar-centric global order. And when uncertainty rises, capital flows into assets that don't depend on any government's promises. Gold, silver. According to reports, nations that had historically held the majority of their reserves in dollar-denominated assets began shifting into gold, into other currencies, into tangible wealth. This was a multi-year structural shift that hit an inflection point in 2025. Catalyst number 3, geopolitical chaos. The ongoing conflict in Eastern Europe between two nations that are massive suppliers of precious metals. Concerns across Europe, political instability in major commodity-producing regions of Africa and South America. And when geopolitical tensions disrupt trade routes, when export restrictions get implemented, when sanctions fragment global markets, industrial users panic. They secure supply ahead of time. They were bypassing public markets to negotiate directly with producers. They were treating metals as strategic infrastructure, not as commodities they could casually source when needed. Catalyst number 4, government debt and fiscal insanity. Interest payments on that debt exceeded defense spending, and there was no plan to ever pay it back. Investors aren't stupid. When they see debt to GDP ratios that are mathematically unsustainable, they buy assets that will hold value even if the currency collapses. They buy metals. Catalyst number 5, the green energy and AI infrastructure. Build out. The transition to renewable energy and the explosive growth of artificial intelligence both require massive amounts of metals. Solar panels need silver. Wind turbines need copper. Electric vehicle charging networks need both. Data centers running AI models need advanced cooling systems. Backup power infrastructure. According to industry projections, solar installations are expected to grow 20% annually through 2030. Electric vehicle adoption is accelerating globally. And the AI data center construction boom is just getting started. These aren't short-term trends. And supply? You can't just open a new silver mine overnight. What's left requires more capital, more energy, more environmental management. Production costs are rising. Now let me show you something that most analysts completely missed in 2025. The rotation between different metals told a story about what kind of crisis the market was pricing in. Early in the year, gold led the rally. Gold is the ultimate safe haven asset. It's what central banks hold. It's what sovereigns accumulate when they're worried about currency stability or geopolitical collapse. Gold moving first signaled that institutional money was repositioning for macro instability. But then silver started catching up. And this is where it gets interesting. Silver historically lags gold early in precious metal bull markets, then experiences sharp catch-up rallies. According to expert analysis, this pattern played out perfectly in 2025. Silver underperformed gold for years, then suddenly exploded. Out of silver's 140% year-to-date gains, about 99% came in the final 6 months of the year. That catch-up rally signaled something important. It meant the market was no longer just worried about currency devaluation. It was worried about industrial supply. It was pricing in shortages. It was anticipating that physical metal would become scarce. And then platinum and palladium joined the party. These metals are primarily used in automotive catalytic converters and industrial applications. Their rally signaled that industrial demand was accelerating and supply was getting tight. Russia is a major supplier of both metals, and geopolitical tensions made that supply vulnerable. Finally, copper surged. Copper is pure industrial demand. It's the metal of economic expansion. When copper rallies, it means the market believes we're heading into a period of infrastructure, spending, electrification, and industrial growth. And copper's 40% gain in 2025 confirmed that despite recession fears, the world was betting on continued infrastructure investment. So the rotation from gold to silver to platinum to copper told a complete story. It started with safe haven demand, it evolved into industrial shortage concerns, and it culminated in a bet that the energy transition and AI revolution would create sustained demand for years to come. Now let's talk about what all of this means for 2026, because the question everyone asks me is, are metals done? Did they already have their run? Am I too late? Here's my answer based on the data I'm tracking. The catalysts that drove metals higher in 2025 aren't resolved. They're intensifying. Federal Reserve policy? According to market expectations, political pressure to cut rates is going to be harsh in 2026. Tariff policies are putting upward pressure on prices. The central bank's independence is being challenged. All of this points toward continued low real yields and continued dollar weakness. Bullish for metals? Geopolitical tensions? The conflicts that dominated headlines in 2025 are not only ongoing, they're expanding. New tensions are emerging. Trade relationships are fracturing. Energy security concerns are growing. None of this is getting resolved in 2026. Bullish for metals? Government debt? It's only getting worse. No major government is implementing austerity. No one is cutting spending. The debt keeps growing and the interest burden keeps accelerating. Bullish for metals. Industrial demand? The AI infrastructure boom is accelerating, not slowing down. Electric vehicle adoption continues. Solar installations are growing. These demand drivers are multi-year structural trends. Bullish for metals. And here's the critical factor that most people miss. Supply deficits don't fix themselves quickly. Silver has been in deficit since 2021. That's 4 consecutive years where the world consumed more silver than it produced. That deficit has to get filled from somewhere. And the only place it can come from is above ground, inventories, which are already depleted, or from higher prices that incentivize recycling and bring marginal production online. Silver stays in deficit through 2026. The structural shortage is real, and shortages combined with surging investment demand create explosive price moves. Let me address the obvious question. What about a correction? What about profit taking? What about the risk that we're at the top? Look, I've been in this market long enough to know that nothing moves in a straight line. Even the most powerful bull markets have corrections. Metals could absolutely pull back 10%, 15%, maybe even 20% in 2026 before resuming their upward trajectory. But here's what matters. The trend is your friend, and the trend in metals is overwhelmingly bullish. Every major moving average is pointing higher. Every structural indicator, supply deficits, central bank buying, industrial demand growth remains positive. Every macroeconomic indicator, debt levels, currency concerns, geopolitical tension, supports higher metal prices. So could we see silver dip from $90 back to $75? Sure. Could gold correct from $4,600 to $4,000? Absolutely. But those corrections are buying opportunities, not reasons to exit positions, because the destination hasn't changed. We're heading toward a world where metals are significantly more valuable than they are today. And here's another way to think about it. Let's say you bought silver at $60 in mid-2025. It rallied to $80 and now you're worried about buying more at $90. But if the target is $150 or $200 based on the structural deficit and industrial demand, does it really matter whether you bought at $60, $80, or $90? You're still capturing the majority of the move. The people who are going to regret their decisions in 2026 aren't the ones who bought metals too high. It's the ones who didn't buy at all because they were waiting for the perfect entry that never came. Let me address the obvious question. What about a correction? What about profit taking? What about the risk that we're at the top? Look, I've been in this market long enough to know that nothing moves in a straight line. Even the most powerful bull markets have corrections. Metals could absolutely pull back 10%, 15%, maybe even 20% in 2026 before resuming their upward trajectory. But here's what matters. The trend is your friend, and the trend in metals is overwhelmingly bullish. Every major moving average is pointing higher. Every structural indicator, supply deficits, central bank buying, industrial demand growth, remains positive. Every macroeconomic indicator, debt levels, currency concerns, geopolitical tension, supports higher metal prices. So could we see silver dip from $90 back to $75? Sure. Could gold correct from $4,600 to $4,000? Absolutely. But those corrections are buying opportunities, not reasons to exit positions. Because the destination hasn't changed. We're heading toward a world where metals are significantly more valuable than they are today. And here's another way to think about it. Let's say you bought silver at $60 in mid-2025. It rallied to $80 and now you're worried about buying more at $90. But if the target is $150 or $200 based on the structural deficit and industrial demand, does it really matter whether you bought at $60, $80, or $90? You're still capturing the majority of the move. The people who are going to regret their decisions in 2026 aren't the ones who bought metals but too high. It's the ones who didn't buy at all because they were waiting for the perfect entry that never came. Now let me show you what specific metals I'm watching in 2026 and why. Silver. This is my highest conviction position. The structural deficit is undeniable. The industrial demand is accelerating. The investment demand is just getting started as more people wake up to the shortage narrative. And silver's historical behavior is to outperform gold in the late stages of precious metal bull markets. We're entering that phase now. Target. Based on the supply deficit math and historical catch-up ratios, I think silver tests $120 to $150 in 2026. And if we get a genuine squeeze where industrial users panic about availability, we could see $200. Gold. Gold is the foundation of any metals position. It's the safe haven. It's what central banks buy. It's the asset you hold when you lose faith in paper currencies. I don't expect gold to outperform silver on a percentage basis, but I expect it to continue grinding higher. Target. Gold likely tests $5,000 to $5,500 in 2026. Every time it corrects, central banks step in and buy. The floor keeps rising. Platinum. This is the contrarian play. Platinum has been overlooked for years because of concerns about diesel vehicles declining. But platinum has industrial uses beyond automotive catalysts. It's used in hydrogen fuel cells. It's used in chemical processing. It's used in medical devices. And supply disruptions from major producing regions could create shortages. Target. If platinum continues its catch-up trade to gold and silver, it could test $800 to $2,000 in 2026. Copper. Copper is the tell. If copper is rallying, it means the world believes in continued economic growth and infrastructure spending. Copper's rally in 2025 was all about AI data centers and electric vehicle charging networks. That demand isn't going away. Target. Copper could test $12,000 to $13,000 per ton if infrastructure spending accelerates and supply remains tight. Let me give you my personal framework for how I'm approaching metals in 2026. First, I'm holding a core position in physical silver and gold. This is not trading capital. This is wealth preservation. This is insurance against currency collapse, financial system instability, and geopolitical chaos. I don't care if the price goes up 10% or down 10% in any given month. I'm holding this for the long term. Second, I'm watching for corrections to add to positions. If silver dips back to $75 to $80, I'm a buyer. If gold corrects to $4,000 to $4,200, I'm a buyer. I'm keeping some dry powder on the sidelines, specifically to deploy into weakness. Third, I'm avoiding over-leverage. Metals are volatile. You don't want to be in a position where a 15% correction forces you to liquidate. Physical metal, unleveraged positions, long-term mindset. That's how you survive the volatility and capture the big moves. Fourth, I'm watching the fundamentals, not the headlines. The mainstream media is going to call every correction the end of the metals bull market. They're going to bring out analysts who say metals are overextended. They're going to create fear. Ignore it. Watch the data. Watch central bank purchases. Watch industrial demand. Watch supply deficits. Those are the indicators that matter. Let me close with one final thought that I think is critical for understanding what 2025 meant and what 2026 will bring. Metals didn't dominate every asset class in 2025 because of speculation or hype or bubble mentality. Metals dominated because the world is changing. The financial system that's been in place since the end of World War II is breaking down. The dollar's role as the unquestioned reserve currency is being challenged. The debt levels that governments have accumulated are mathematically unsustainable. The geopolitical order is fracturing. And in that environment, capital flows to safety. It flows to tangibility. It flows to assets that have been money for thousands of years and will still be money thousands of years from now. Gold, silver, platinum, copper. These aren't just commodities. They're the building blocks of civilization. They're the metals that enable technology, that power infrastructure, that preserve wealth across generations. And as the paper system becomes more fragile, as confidence in fiat currencies erodes, as governments print more and borrow more and spend more, metals become more valuable, not because of emotion, because of mathematics. The screen can lie, paper can be printed, but metal mines cannot. Supply is finite, demand is growing, and the repricing has only just begun. This is the metal guy from Currency Archive. It's January 20th, 2026. Metals dominated every asset class in 2025, posting gains that left traditional investments in the dust. Silver surged 145%, gold climbed 64%, platinum gained 135%. The top 15 ETFs were all precious metals funds. And the catalysts, Federal Reserve policy, dollar weakness, geopolitical chaos, government debt, industrial demand, they're all still here. They're all still intensifying. But the structural deficits remain, the central bank buying continues, the infrastructure boom accelerates. If you missed 2025's rally, you haven't missed the opportunity. You've witnessed the opening act. 2026 is when the real repricing begins, when the supply shortages become undeniable, when industrial users panic, when investors finally understand that the paper system is breaking. The choice is yours. You can hold paper assets and hope that governments and central banks somehow fix problems they created. Or you can hold the metals that built civilization and will still have value long after today. His currencies are forgotten. This is the metal guy. Get out of paper, get into metals, before the repricing accelerates, before the shortages intensify, before the system breaks. Do it now.